Welcome to the Mortgage Brothers Podcast. I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. We're the Mortgage Brothers team right here in Phoenix, Arizona. And this is our 8th podcast. And we are going to be bringing excellent content to you today. Right, Tom?
That's right. Because we know you're driving in your car right now or listening from your comfy office and thinking, boy, who do I talk to about buying a condo?
That's right. Condos.
Everyone thinks about condos a little bit, whether you're buying or your friend is buying or your retired parent thinks about buying a condo. Everybody ends up touching a condo in some way, shape, or form.
That's right. I think if you've never been in a condo, some people have never been in a condo and they'll drive down the road and, every now and then they'll look over and then say, I wonder who lives there. I mean, who lives in these condos? The thing is we get a lot of questions about them. So we're going to be talking about condos.
You know who lives in condos? People that want to own apartments.
There you go. That's right.
So that's kind of a super simple way of what is a condo. Picture your apartment that is converted into a property that you can own.
All the amenities of an apartment right there.
Right there.
With ownership.
That's right.
Okay.
So one of the things that we talked about was, what exactly is a condo? And without getting into too much of the nuances of it, I think the most important part is you're literally owning a piece of air, like an apartment. You are going to be one unit within a large project. So you typically never own the lot, but you simply own a unit.
Yeah.
They call it a horizontal regime ownership matrix, and you would own one of those units. And I think that's probably one of the biggest pieces.
Yeah. I'll just say that, if you see a skyscraper, it will be with a bunch of residents in it. It's got to be a condo, because what you'll notice about townhomes or patio homes, they might be attached. Some of them might be 2 stories. They might look like a condo, but if you don't have anyone living above you, then you have a condo. Okay, because you can't have 2 people who own the same dirt underneath you.
That's right.
Unless it's a condo. Townhouses, or you'll never see like a 4-story multiple unit townhouse.
Right. So if you look at the property food group, so to speak, single family, townhome, patio home, even a manufactured home, those were all literally affixed to the ground. So they don't move. They own the dirt. They've got a stake in the dirt, so to speak. A condo literally floats. So it's one of the most unique. Actually, it is the most unique. Besides a TP, I don't think we can do loans on TPs. But it's the most unique property type that we deal with. Yeah,
I tell people too that imagine there's 200 units. There's 200 owners of a condo. Look at the patch of grass in front. You own 1/200th of it. Everyone else owns 1/200th of it. Every unit owner, every piece of dirt, every piece of gravel, you own 1/200th.
That's right. I like that,
because that's anything that's in the common area, the dirt, anything there in the common is all prorated.
Okay, so let's talk about some of the important things for people to be aware of when they're looking at a condo versus really any other product type. And I don't know if you want me to start, but
go ahead. I mean, I think what we want to talk about, just so people know, is that we're going to talk about kind of the good and the bad, the advantages, disadvantages.
Yep. Okay, so one of the biggest pieces, and you'll hear these, is the condo warrantable, or is it non-warrantable? I think intuition would tell you warrantable is good and non-warrantable is a negative, and that's absolutely correct. So anytime you think condo, you want to be thinking we need to be in a warrantable condo. What does warrantable mean, Ed?
Yeah, so there are several things that make a condo, the complex, warrantable. Let me give you some one of the big ones that we're looking for. Does any one person or entity own more than 10% of the units? Let's just say you have this massive investor, this big old group, they own 40% of the units. Well, if that happened, that entire complex would be non-warrantable, which means conventional financing would not be allowed.
And where's the big deal if one person owns more than 10%? What do they care?
Yeah. What the bank is concerned that there's high risk that one investor controls so much of the collateral in there. The risk is that something happens to that one investor, makes bad decisions, the whole thing can turn.
Right. And if things turn and 10% of the units go up on the market for sale and they're all competing for a few buyers, guess what that means for the value of your condo? It goes down.
That's right. The bank wants the collateral to be secure, and they can't. That's a great point about he can just say, hey, I'm going to list them all for sale.
That's right. Yep. All at one time. So ultimately, that's a good thing. Warrantable, there are limitations, but it's ultimately there to protect the lender, which ultimately protects you.
Yeah. And I think another one that's pretty big is, when you have a new complex at condominiums being built, if the developer still owns and operates, the majority of, it basically has control of the HOA, that also is a non-warrantable situation.
Okay, so typically newer projects that are still in development phases, they maybe 2, 3, 4 phases.
Yeah.
The developer, in order to complete that unit, would still want to be what they call the declarant, which is be able to make all the rules, because he wouldn't want to turn anything over while he's still under construction. So it's not until a project is typically fully complete that the developer washes his hands and then hands over his keys as declarant over to a association for the management. So that's a big thing.
Okay.
Is the developer still active? The developer should not be active.
And just one more big one. I probably should have mentioned this in the beginning, right there with the talking about the investor. If there's someone who owned more than 10%, if there are more than 51%. Or sorry, I should say, if there's a majority, so anything over 50% of the units are owned by investors, then the complex is also non-warrantable. So if you just have a bunch of investors in general buy up places, that will create a non-warrantable situation.
And that would be a non-warrantable situation under the investment property category, right? If you're buying it as a primary home.
You know what? You're totally right. Because that rule does not apply if you're going to occupy the home, right?
And a lot of our condo buyers, are actually buying them as investments. It's a way to go in, a low barrier to entry because of the sales price. So a lot of our borrowers are looking for condos as investment properties. So that's another one. So one entity can't own more than 10%, and you can't have a majority of the units owned as investor properties.
That's right.
Okay. What else we got? There's some extra closing costs typically involved. Not a lot, but enough to make the condo buyer who's looking at them for reasons of low price, just to be aware of. There's some extra closing costs.
That's right. So those would be typically a condo questionnaire, the master policy. We have to, as a lender, we have to reach out to the HOA, get a condo questionnaire filled out. There's either going to be a full review or a limited review form that we're going to have them fill out. And also, we're going to ask them for a copy of their master policy. Well, those HOA companies, they always charge, right? You
mean they don't do it for free?
Yeah. You know what? There was like one group last year that we send out the request and like, okay, here it is. We're like, whoa, I haven't seen that in years where anyone's done it for free. But yeah, and so they're typically going to cost what we're seeing, $250 for condo questionnaires and maybe $75 to get the master policy. So this is one way HOAs make some money to help, fill up their coffers.
So maybe closing costs go up about $350 over what a single family home might be.
Yeah.
Nothing big, but to the person who's worried about their down payment and having enough for that, an extra $350 for closing costs, might be a small deterrent.
Yeah. And I'm going to, maybe Tom, right now is a good time to talk about these questionnaires, or just briefly, right? Because we want to get right through this. And so we just want to make sure everyone understands. These questionnaires, there's a difference between this full review I was telling you about and a limited. The full has like 25 to 60 questions. I mean, it takes a ton of time if it's manually done by the HOA to fill out these questionnaires. And it can be tricky. I mean, if they answer it wrong or they don't know what they're doing and they just answer it, incomplete, it can go back and forth between underwriting and the HOA, back and forth. And that can be a real hassle. One of the big downsides of getting a condo questionnaire, which is one of the kind of like our lead up to one of our banks we work with, that actually has a list of all the condos that they have pre-approved, so we don't have to order this full questionnaire.
Wow. So you mean if you go through the Mortgage Brothers team, they've got a wholesale lender
That's
that
right.
already has kind of a master list of all the condos where they already have approved that don't need questionnaires.
We've been looking for a bank that would do this for a long time, and great news is that we have a bank now, just now, and just recently, a couple weeks ago, that has opened that up to us, and it's cool.
Okay.
So,
yeah, I like it. Okay, we talked about insurance. How about pricing? So when you look at the different property types, how do condos fit into the whole pricing matrix? Are they more expensive in the interest rate or lower?
If the down payment is if the borrower's putting 25% or more down, pricing is going to be the same. There's no extra adjustment. But most people don't put 25% down. So there's an extra adjustment for the condo, and so you're probably going to see an 1/8 to 1/4% higher on the interest rates. So
that's important. So when you start to look at why people look at condos from a primary occupancy standpoint because of cost, you just need to be thinking about the slightly extra closing costs and the slightly higher interest rate. Not a lot, but sometimes it doesn't take much for the first time home buyers to realize maybe a condo is not a perfect option for them when you consider some of the closing costs and interest rate sides.
That's right. And Tom, I know we're always talking about HOAs. I mean, so I think this is kind of the last thing that we were going to talk about maybe is the HOAs. What do we usually tell people? I mean, what are
so it's interesting. Obviously, single family homes have HOAs, but they're going to be large tracts spread out, parks and recreational facilities that typically don't have, huge budgets. And so the HOA dues on a single family home, can be anywhere from, call it $35 on up to maybe $85, $90, $100. But when you get into a condo, it's kind of the opposite. Everything is squished together. And you'd think the pricing would be better on a lower price condo, but it's actually the opposite. The HOA dues can be high. And they can literally be on the low side 100 and go all the way up to what?
350?
350?
I mean, right, depending on the price range. But yeah, I mean, if you're in Scottsdale, waterfront areas, you can be at 600, 750. But, the average ones we see are about 250 to 350.
Yeah. 250. So when you're talking to your first-time home buyer, or you being the first-time home buyer are thinking about getting into a condo, you're going to be thinking about this HOA. What does $250 a month mean to them? It obviously, means a monthly payment, but what does that mean? I mean, if you were to compare that to a single-family home that didn't have any HOA.
Yeah. What I tell people is that to purchase that condo with a $250 HOA, they just lost approximately $38,000 in purchasing power, meaning that someone with a condo, their mortgage payment, their total payment would be equal to the person who bought a single family residence that was worth $38,000 more. So,
So if you had a condo at $150,000 with a $250 HOA, that's the same as a single family home for $190 with no HOA.
Yeah.
So single family home $190 or condo at $150 with the $250 HOA.
Yeah, I just got off the phone with the borrower yesterday, and I told him, okay, you're approved for $330,000 on a conventional loan, and I said, and that's going to be for a single family residence. And he goes, oh, okay, I'm going to go look for a condo. I'm like, okay, wait, and anyway, at his price level, his HOA was a little higher. I had to tell him that he had to go down to like $270,000 from $330 to $270.
That's a big deal. That's real money. All right. I wanted to also throw this out too, because a lot of our condo buyers, not the investors, but the buyers getting into their first home, sometimes don't have the best credit. If you look at condos from an FHA loan perspective, it's restrictive, and that's really, really important. If people do not qualify for conventional loan because they don't have 620 or above credit score, they will fall into the FHA bucket. When you fall into the FHA bucket, there is a list that the condo project has to be on. And it's not the wholesale pre-approved list that we talked about prior, but it has to be on the FHA condo approved list, which in this town, there aren't many.
That's right.
So it's a little bit contrary to thought. You'd think, FHA would be a little bit more lenient for first-time home buyers, but it's really because they're protecting the first-time home buyer. They want to make sure that any condo that an FHA loan is on is that it meets certain requirements and guidelines.
Yeah.
And that list can be small. So keep that in mind. Condos are usually best suited for those with conventional credit scores, which is above 620.
Yeah, and that list, the list also applies to VA loans as well. So any veterans out there that are thinking of condos, there's few condos on that VA approved list. So.
And is that VA list the same list as FHA, or are they two separate?
Two separate. They maintain them differently. And so, reach out to us if you are thinking about a condo. You know what? If you like the idea of a condo, I just recommend a lot of people look at a townhouse, look at a patio home. But to be careful when you are looking at those, because sometimes you'll see townhouses, or you'll see places they'll market them townhomes, the townhomes of the lakes, and really the legal descriptions show them as condos.
That is exactly right. And one way to do this gets a little bit techie, but if you ask your realtor, how do we know for sure this is, a townhome or a condo? You go to the legal description, and what's the key word you're looking for to find out if it is a condo?
The horizontal regime is one that you'll see in a legal description, but also a lot. You were looking for a specific lot number, or if it has a lot number, it could be evidence of that it is not, like it's actually you actually own the lot. Also, you'll see, there's several things that we're looking for, and each legal description is a little bit different, but those are pretty much the.
So just to recap on that, if you see horizontal regime, or if you see unit, that should trigger condo. If you see anything to do with lot or pad or land, that's typically townhome, patio home, etc. So you see the word unit, yet the beautiful marketing piece says townhome, likely that townhome is actually a condo.
Yeah, good point.
All right. What do we miss?
I'm sure we missed something, but I think we did enough damage again.
I love it. All right. You ready to call it a day?
Yeah, that's right. It's time to go home.
Okay.
All right. See you, everyone. Hey, guys. Thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to Tom at azmortgagebrothers.com, or yours truly at Eddie at azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisor before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917, and 1618695, Equal Housing Lender.